Inflation and deflation are two opposing economic phenomena that have significant implications for individuals, businesses, and governments. These terms are often discussed in the context of macroeconomics, and they can have far-reaching effects on a country's overall economic health. In this comprehensive exploration, we will delve into the fundamental differences between inflation and deflation and analyze their respective implications. Inflation, the persistent rise in prices. Inflation is a term that is commonly used to describe the sustained increase in the general price level of goods and services within an economy over a period of time. It is essentially a decrease in the purchasing power of a currency, meaning that, over time, one can buy less with the same amount of money. Inflation is typically expressed as an annual percentage, and it can be caused by a variety of factors. One of the primary drivers of inflation is demand-pull inflation. This occurs when there is an increase in consumer demand for goods and services, which leads to a surge in prices. It can result from an increase in consumer confidence, increased government spending, or a booming economy. When people have more money to spend and are willing to spend it, businesses often respond by raising prices to capitalize on the increased demand. Cost-push inflation, on the other hand, occurs when the cost of production for businesses increases. This can happen due to rising wages, increased prices for raw materials, or other factors that drive up the cost of goods and services. In response to higher production costs, businesses may raise their prices, which leads to inflation. Another factor contributing to inflation is built-in inflation, which is related to expectations. When people expect prices to rise, they may demand higher wages to compensate for the expected increase in the cost of living. This can create a self-fulfilling cycle where price and wage increases feed into each other. The implications of inflation are both varied and complex. One of the immediate effects of inflation is that it erodes the purchasing power of money. If you have $100 today and the inflation rate is 3%, your money's real value decreases to $97 the following year. This means that you can buy less with the same amount of money over time. However, inflation can also have positive effects. Moderate inflation is often seen as a sign of a healthy, growing economy. It encourages spending and investment, as people are motivated to use their money rather than let it lose value. Central banks and governments often target a specific inflation rate, aiming to keep it within a reasonable range to achieve economic stability. Inflation also benefits debtors by reducing the real value of their debt. For example, if you have a fixed-rate mortgage, your monthly payments remain the same, but the real burden of your debt decreases as inflation rises. This can provide relief to individuals with substantial loans. On the flip side, inflation can harm savers and people on fixed incomes, as their money's value declines, making it harder for them to maintain their purchasing power. High inflation rates can be particularly detrimental as they erode savings more rapidly. Deflation, the decrease in prices and its consequences. Deflation is the opposite of inflation and refers to a persistent decrease in the general price level of goods and services within an economy. In a deflationary environment, the value of money increases, meaning you can buy more with the same amount of currency over time. Deflation can occur for various reasons and has its own set of implications. One of the main causes of deflation is a decrease in consumer demand. When people are hesitant to spend money due to economic uncertainty, businesses may lower their prices in an attempt to attract customers. This leads to a general decline in prices, which is known as demand-pull deflation. Another factor contributing to deflation is cost-push deflation, which is the result of declining production costs. This can happen when technology advancements lead to more efficient production methods or when there is a surplus of raw materials that drives prices down. As production becomes cheaper, businesses may reduce their prices, causing deflation. Expectations can also play a role in deflation. If people anticipate falling prices in the future, they may delay purchases, hoping to get a better deal later. This delay in spending can exacerbate deflationary pressures. Deflation can have significant and far-reaching consequences. One of the primary concerns is that it can lead to a deflationary spiral. As prices fall, people delay spending, expecting even lower prices in the future. Businesses, in turn, face declining revenues and may reduce production, leading to job cuts and reduced wages. This creates a negative feedback loop where lower consumer spending results in even lower demand, further driving down prices. Deflation is particularly concerning for borrowers. If you have a fixed-rate loan, such as a mortgage, your monthly payments remain the same, but the real burden of your debt increases as the value of money rises. This can lead to financial distress for individuals and businesses with significant debts. Moreover, deflation can stifle economic growth and investment. When prices are falling, businesses may delay investment and hiring, as they expect reduced revenue and profitability. This can lead to a slowdown in economic activity and potentially a recession. Central banks and governments typically try to combat deflation by implementing expansionary monetary policies, such as lowering interest rates and increasing the money supply. These measures are aimed at encouraging borrowing and spending to stimulate economic growth and prevent the negative consequences of deflation. Inflation versus deflation. A delicate balancing act. Inflation and deflation represent two ends of the economic spectrum, and both can have significant implications for an economy. The ideal scenario for policymakers is to maintain a delicate balance between these two forces, aiming for moderate inflation. This balance is often referred to as price stability, and it is typically targeted by central banks around the world. Price stability, characterized by a low and stable inflation rate, is seen as the optimal condition for economic growth. It provides an environment where businesses can make long-term plans, consumers can make informed spending decisions, and the value of money remains relatively constant. Central banks, such as the Federal Reserve in the United States and the European Central Bank in the Eurozone, often set inflation targets of around 2% as a way to achieve price stability. However, achieving this balance is not always straightforward. Central banks use monetary policy tools like interest rates to influence inflation and deflation. When they want to combat inflation, they may raise interest rates to reduce borrowing and spending, which can help cool down an overheated economy. Conversely, to combat deflation, central banks may lower interest rates to encourage borrowing and spending, thus stimulating economic activity. The effectiveness of these tools depends on the economic circumstances at the time. For instance, during the global financial crisis of 2008, many central banks lowered interest rates to near zero levels to combat the threat of deflation and stimulate their economies. Inflation and deflation's impact on investments. The dynamic interplay between inflation and deflation also has a significant impact on investments. Investors need to consider these economic forces when making decisions about asset allocation and portfolio diversification. Inflation can erode the real returns on investments. For example, if you invest in a bond that pays a fixed interest rate, the purchasing power of your interest income will decrease if inflation rises. This is why investors often seek out assets that have the potential to provide returns that outpace inflation, such as stocks, real estate, and commodities like gold. In times of deflation, the value of fixed income investments may increase in real terms, but the overall economic environment can be unfavorable for most investments. As mentioned earlier, deflation can lead to reduced consumer spending, decreased corporate profits, and economic stagnation. This is a challenging environment for investors, as it can lead to lower returns and reduced investment opportunities. The implications of inflation and deflation are also relevant for central banks, as they influence their monetary policy decisions. Central banks aim to strike a balance between encouraging economic growth and maintaining price stability. When inflation is a concern, they may raise interest rates to cool down an overheated economy and prevent excessive price increases. Conversely, during periods of deflation, central banks may lower interest rates to stimulate economic activity and prevent a downward spiral of falling prices. Global implications and international trade. Inflation and deflation have far-reaching implications not only within individual economies, but also in the global context. Exchange rates and international trade are areas where these economic phenomena can play a significant role. Inflation can affect exchange rates, as changes in relative price levels can influence the value of a country's currency in international markets. High inflation rates may lead to a depreciation of a country's currency, making its exports more competitive on the global stage. Conversely, low inflation or deflation can result in a stronger currency, which may harm a country's export industries by making their goods more expensive for foreign buyers. In the realm of international trade, inflation and deflation can have various effects. For example, if a country is experiencing high inflation, its goods and services may become more affordable to foreign buyers due to a weaker currency. This can lead to increased exports and potentially a trade surplus. Conversely, during deflation, a country's stronger currency may lead to decreased exports and a trade deficit. Global economic conditions, including inflation and deflation, can also influence international investment flows. Investors often seek opportunities in countries with favorable economic prospects and stable or appreciating currencies. High inflation or the threat of deflation can deter foreign investment, as it introduces uncertainty and risk into the investment environment. Government policy responses. Governments and central banks have various policy tools at their disposal to address the challenges posed by inflation and deflation. These policies are designed to stabilize the economy and mitigate the negative effects of these economic forces. In response to high inflation, governments and central banks may implement contractionary monetary policies. These measures can include raising interest rates to reduce borrowing and spending, which helps cool down an overheated economy. Additionally, governments may reduce public spending to curb inflation. In the case of deflation, governments and central banks typically employ expansionary monetary policies. Lowering interest rates and increasing the money supply are common measures to encourage borrowing and spending, stimulating economic growth. In some cases, governments may also implement fiscal policies, such as increased public spending or tax cuts, to combat deflation and support the economy. These policies are aimed at achieving price stability and ensuring that the economy operates within a reasonable range of inflation. However, the effectiveness of these measures depends on various factors, including the overall economic conditions, the severity of inflation or deflation, and the effectiveness of communication with the public and financial markets. Conclusion. Inflation and deflation are two opposing economic forces that have significant implications for individuals, businesses, and governments. Inflation results in the persistent rise in the general price level, eroding the purchasing power of money, while deflation leads to a persistent decrease in prices, increasing the value of money. The implications of these economic phenomena are diverse and complex. Inflation can benefit debtors and stimulate economic growth, but harm savers and individuals on fixed incomes. On the other hand, deflation can lead to a deflationary spiral, negatively affecting economic growth and borrowers while benefiting savers. Achieving a balance between inflation and deflation is a primary goal of central banks and governments, as it is key to economic stability and growth. Price stability, characterized by low and stable inflation, is often targeted to provide an environment where businesses and consumers can make informed decisions, and the value of money remains relatively constant. Investors need to consider the impact of inflation and deflation on their portfolios and make informed decisions about asset allocation and diversification. International trade and exchange rates are also influenced by these economic forces, affecting the competitiveness of goods and services in the global market. In response to inflation and deflation, governments and central banks have various policy tools at their disposal. They use monetary and fiscal policies to stabilize the economy, control inflation, and combat deflation. The effectiveness of these policies depends on the specific economic circumstances at the time. In conclusion, understanding the differences between inflation and deflation and their implications is crucial for making informed economic decisions and planning for the future. These economic forces are ever-present and play a vital role in shaping the financial landscape for individuals, businesses, and governments alike.